G'day folks, welcome to another weekend update for the 12th of March, and we've had a pretty amazing week last week with the Australian market heading down quite significantly on Wednesday, Thursday and Friday. That was largely led by the resources sector far more than anything else, and it raises the question now about where to for the Australian market, because I'm seeing quite a disconnect between what's happening in the US markets and what's happening in the Australian markets, and the reasons for that disconnect I went into some detail in the daily alerts this weekend. It just makes it a little bit more tricky to determine the short-term direction in the Australian market, and so given that uncertainty is the reason why I've recommended very strongly that you pull back to a much lower level so that we can reassess the likely short-term direction over the next week or so, and start from a more stable base, if you like. So what I want to do in this weekly video is to have a look at some of the bigger picture charts. So we'll tend to look a bit more at weekly charts to try and get a sense of where we are in the bigger picture, because sometimes it's easy to get a bit too focused on the short term and not actually be looking at the wider view. So first of all, we just need to just make mention of the fact that this is general advice only. At the end of the day, you need to make your own trading decisions. You've all been provided with the training. These are my views only, and you really need to make your own decisions. Now let's have a quick look at a summary of the markets. Firstly, with the S&P 500, to me the short term is not clear. The market did go down a little bit on the futures on Friday night, but certainly recovered. It's possible that was the bottom of this correction, but I think it unlikely. I still think the odds favour a bit more downside yet. When it comes to the Australian indexes, the ASX 200 has fallen out of that trend channel that it had been in since July last year and fell out of it quite dramatically. The Small Ordinaries Index is struggling, but I did notice on Friday that there were several really good rebounds with some of the smaller stocks, particularly off the 150-day moving average, in some cases off the 50. So that was good to see that there's still some support coming into the market. Now when it comes to commodities, silver is unquestionably the strongest of the precious metals. Gold's still doing okay, but silver by far the strongest. Copper is just holding onto its key level. There is a more important level just a bit lower down, but copper's still holding on to that 420 area. So we'll have a look at we'll go and have a look at some of the index charts first. So the first one is the S&P 500 index. Let's pan back and have a bigger picture look. So the S&P had retraced 2/3 of the move from 2007 down to the bottom in 2009. It retraced 2/3 of that move, which was a level of 1229. Got rejected from that, so that was a perfect retracement level. It then retraced 1/3 of the level of this rise here, so the ratios really have been working extremely well on a big picture level, and that's why I think we continually need to reinforce that point with ourselves, because quite often in the short term we just can get too close to the action. From there we've had a very strong run up, and we've broken through this reasonably important 1300 area, and up until just on Thursday, even though we did have a decline a couple of weeks ago, this trend channel, which has been very strong and holding above the 50-day moving average, remained intact. So this is our A wave down here, this is the B wave back up, and what I've been expecting is this C wave down here to complete this correction. At the moment, markets are still just hanging on to this 50-day moving average, and the two corrective targets, I guess, one is this 1276 area if it's a more mild correction, and the other one is if we get a deeper correction, then we come into either the 61.8% level of this run from this point here, so November to the peak. So 61.8% retracement brings us back to 1237. We've also got 1226 as the level from the start of this rally in July last year. So the first retracement level on that is 1226, so they're pretty close. And we've also got this old peak here at 12, around about the 1229 area as well. So this area of 12, let's say 1225 to 1235 is really quite an important area. So if 1276 goes, then I think we're going to see a deeper correction. But you'll notice that even if that were to occur in the S&P, that we're still in overall uptrend. If this market was to pull back to that level, we would still only be sitting on the 150-day moving average, which is still rising, and the market is still above it. So from a big picture perspective, such a correction would still retain the integrity of the uptrend in the US. And that's the real challenge at the moment, because the Australian market is nowhere near as strong, and if the US market fell that far, then we would certainly not be still in an uptrend. So you can see here, basically the Australian market is at the same level now, at the index level, that it was in September of 09. So basically it has gone nowhere, whereas the US market is much higher. If the US falls to that deeper level, then I would expect that we're probably going to be down here around about the possibly 4200 area, which is still another 450 odd points further down. I think that's entirely possible. On a shorter term daily basis, we are getting oversold now, so a bounce from here would not surprise. So I would expect to see a bit of a bounce on Monday morning, and perhaps follow through for a few days next week. But I think it highly likely that the index is still heading down. Now, just to underscore my point on the underperformance of the Australian market, which is something that we need to bear in mind, and this is a comparative chart of the various indexes around the world, all starting from the same 0 point back in September of 2009. So getting on towards 3 years, getting on towards 2 years. So you'll notice here the top line, the green one, is the German DAX index. The red one is the S&P 500 in the States. We've then got the brown line is the FTSE in the UK, and then the blue line, of course, is our ASX 200. And you'll notice the substantial divergence in performance, particularly since around about March of last year, that the American market, in fact all markets, even the UK market, which is, they're a bit of a basket case economically compared to us, even they've outperformed our market quite significantly. But you can see there's now this massive divergence between the performance of our market and the performance of the US market. And I discussed that, the reason for that in the daily alerts. Certainly it's part of the global flow of capital back to the US, but you can see it doesn't seem to be affecting the UK market or the German market to anywhere near the extent that it is our market. So of the significant markets around the world, there's no question that we're pretty much the real lagging market in world terms. And that's pretty disappointing, and I think it's also partly because of this extraordinarily incompetent government that we've got, with policy on the run is not helping, and the sooner we can get an election and get a sensible government in place, then the greater the chance we might have that our stock market might start behaving sensibly. Okay, let's have a look at the Small Ordinaries Index. And the Small Ordinaries Index, as you can see, has significantly outperformed the ASX 200 over that period of time, but has definitely come off the boil in the last few days. You can see there's been quite a lot more of a decline there than there is at the larger index level, which is what you would expect. Now let's have a look at the bigger picture on the Small Ordinaries. You can see that we've had a very strong run. Let's just have a look at the price retracements on this. So the price has moved up, broke through the 50% retracement of this run down from 2007. Hasn't quite made it yet to the 61.8, which I think is likely that it will make it there. So I still think, despite this correction and the fact that we might get an even deeper component to this correction now, I still don't think we've seen the end of the run for the Small Ordinaries Index as a whole. Still looking for that 31.21 area. To date, we've been as high as about 29.50. So there's still a ways to go yet for the Small Ordinaries Index, but we're probably going to get a more significant correction before that happens. So looking at the bigger picture, we've now retraced beyond the 61.8% of this small run here from the most recent run from November to the peak. So we're now down into deeper correction territory. We closed right on the 150-day moving average. You'll notice the RSI is showing that we are oversold. So a bounce in the short term would be pretty normal. If we look at the bigger retracement from when that run started back in July of last year, then the first level that we're looking for is around 26.67, which also corresponds with some of these lows through here. So that's a target, and then we've also got potentially a lower target down here, as I discussed in the alerts. So because of the possibility of a deeper correction, and I was a little surprised by the speed with which the Small Ordinaries Index went down, considering that the sentiment towards global stock markets really had not changed all that much. Yes, we had a bit of a drop in the S&P, but sentiment was still pretty good. So there really has been a very adverse reaction to commodities and to the Australian market. I think it's completely overdone, but nevertheless, markets are what they are. So hence I just think it's prudent to really strip right back, and it's much easier then to start to rebuild, and I'll be looking to be rebuilding from deeper retracement levels. So far, the 50-day moving average has been providing support to a lot of small caps. The 38.2% retracement level has been providing support. What I want to do now is start to look for entry levels, perhaps coming off the 150-day moving average or off the 61.8% retracement level. I just think that's the prudent thing to do just at the minute. So next, I would like to take a look at the finance index. So this is the banking index, and we're looking on a weekly chart basis here. So if we take a look at this run down from the peak in 07 to the bottom, you'll notice that we've made it exactly to the 50% level with these highs. So we've formed a double top on the banking index on a weekly basis. So that's made it back up there to the 50. It would be normal for markets to push on to the 61.8 on a bigger picture view, But you can see that the banking index has essentially done nothing. We're at the same level now that we were at in August of 2009. So the banking index has gone essentially sideways for 18 months. We did have a little bit of a false break of this range 3 or 4 weeks ago, but we're now fairly quickly back into that range, and I would say that we'll probably test the bottom of that range at least. So there's a few more 100 points, I believe, downside on the finance index. It's not oversold on a weekly basis yet. It's still sitting in the mid 40s, so there's certainly more downside in the finance index. Let's have a look at a weekly chart on the materials index. So we'll do the same exercise here, and you'll notice the retracement from the top here in 08 to the bottom. The market certainly made it to the 61.8% level right there in January. We then retraced off it, so good symmetry there, formed a double top and eventually broke through that double top. So we've actually gone beyond the 61.8. We've also got above this important resistance level at 14,000. Excuse me. So you notice that we've had an initial break of that level, but last week, very emphatically, the index back into that range. So it's highly likely, with such a substantial move on a weekly basis, and the fact that we're not yet oversold on that index either, that we could get some more downside. Now that means that BHP and Rio are probably going lower, which seems extraordinary that that they could go any lower from where they are now, considering the fundamentals. But just looking at it from a chart perspective, we've broken this low of the week of the 4th of February. We're fairly close to closing below these tops here in April of 2010 and January of 2010. So a close below those lows, a close below those tops of around 13,400. We closed at 13,408. So any lower close below those levels, I think we're going to see quite a bit more downside in the materials index yet. So not a particularly good sign, that candle. That looks really ugly, and I think it highly unlikely that the markets are going to just go straight back up from here after a week like that. It just normally doesn't work that way. You can see over here we got 2 significant weeks down before we had a recovery. Then we got this time we got 4 out of 5 weeks down before we got a recovery. I think it highly likely we're going to get at least another week or possibly another month to the downside on the materials index. So all this is doing really is just setting up great opportunities. I mean, it's possible we could be buying BHP sub $40, and if that's the case, then to my mind there's not a heck of a lot of risk buying those sort of stocks at those sort of levels. Now I'd like to take a look at the important copper chart, and you can see here copper's been in amazingly strong uptrend. So we had a big run up here, a bit of a pause for a few months, and then another really good run. Copper has just broken out of this very steep inclined uptrend, and the 2 areas that I'm looking for support, one is this area here, which we bounced off, which is 1409. Bounced off there perfectly on Friday night. So I'll just tighten in on there and close back near the highs and back just over $4.20. But this is really the key one, $3.90, which is the 38.2 retracement of this run. If that were to break, then we would probably see copper prices down around 345 or so, and that would do a great deal of damage to global resource stocks. So watching this copper price is pretty important, not just for copper stocks but for all commodity stocks. Next is gold, and the gold price, as you can see, everyone knows, incredibly strong uptrend. The colours on these two moving averages are reversed. Apologies for that. This red one's the 150. In fact, sorry, this green one is the 150, and the red one is something else altogether, so I'll get rid of that. Okay, so this is the 150 moving average. You can see the price has been holding this inclined trend line and the 150-day moving average very well. We had a triple top through here. We went above that triple top, but are now back into the range just around about that top. So if we confirm down underneath 1410, then I think we'll probably come back down to around 1365, 1370, which would then confirm a bit more of a sideways move. So really, if we want this uptrend to really continue on quickly from here, we really need gold to get back above about 1435 fairly smartly. Next is silver, and you can see silver has been in a much stronger uptrend, because here's the 150 day on silver, and you can see how far above the 150 day that the silver price is, and really not showing any signs of weakening to my mind. It did pull back and retest this little top here from the 21st of February on Friday night, but then powered straight back up again and closed very close to its highs. So whilst silver is overbought in the short term, it's still looking quite strong to me. So that's the big picture view of what's going on in the market. I believe, given the uncertainty in there's a little bit of uncertainty in my mind about the S&P, whether it in the very short term, whether it will push back further to here, or whether we'll go down and test lower levels. We're just sitting in the middle, so that's a bit of a flip of a coin on that one. So a bit of uncertainty over the very short term in the S&P. I still think the long term, the S&P direction, you can only say is up. There is no evidence to suggest anything other than that. But when it comes to the Australian market, we've now got this added substantial underperformance, which last week really was at quite an extreme. So it just makes the short-term probability in the Australian market rather unpredictable. And as you know, whenever I get to a point of feeling that the market is unpredictable, then the only way to deal with that, to my mind, is just to pull back to a much lower level. It means you don't have to worry too much about any sudden declines that might occur. Yes, it's possible that you might miss out on a little bit of profit opportunity, but far preferable to get your money out of the way, and then position yourself to pick up some better bargains at even better prices. So I'm going to be, from here on, a little bit more circumspect about the entry prices. I'll be looking for entries on deeper retracements, because I think there's really some signals out there that indicate in the shorter term we're going to get a deeper correction. Doesn't change my view at all about commodities in the long term. None of that changes. It just changes the entry levels and perhaps pushes out the time frame a little bit. So that's it for this week. We'll talk again next weekend. Cheers.